Ferguson's law states that great powers begin their decline when interest payments exceed defense spending. For the first time in American history, we've crossed that threshold. $38 trillion in debt, growing by $69,713 every single second, with interest payments that now exceed what we spend on national defense. Jamie Dimon, CEO of JPMorgan Chase, put it bluntly: "We're driving toward a cliff at 60 miles per hour and going broke slowly." When Ronald Reagan took office in 1981, our national debt approached $1 trillion, a number that seemed astronomical back then. It took us 200 years to reach that milestone. Now we're adding $1 trillion every 2 months. The debt hit $37 trillion in August 2025, and on October 17, 2025, we crossed $38 trillion. At our current pace, we'll hit $40 trillion by 2027. But here's what makes this different from every previous debt crisis in American history. The math has fundamentally broken down. We're not just borrowing more money. We're borrowing money to pay the interest on money we've already borrowed, with the federal funds rate at multi-decade highs and the 10-year Treasury yield swinging wildly between 4.5% and 5.2%. We're caught in a financial death spiral that even the most optimistic economists can no longer ignore. The speed of our debt accumulation is unprecedented outside of wartime. According to the Peter G. Peterson Foundation, this is the fastest rate of debt growth we've seen outside the emergency spending during COVID-19. Michael Peterson, the foundation's CEO, said, "If it seems like we are adding debt faster than ever, that's because we are." Every day, our government spends about $8 billion more than it takes in. Every second, as you're listening to this, our debt increases by nearly $70,000. By the time this ends, we'll have added roughly $10 million to the national debt. And here's where it gets truly alarming. Interest payments on this debt consumed $970 billion in fiscal year 2025. That's more than we spent on the entire Department of Defense, more than we spent on Medicaid, more than we spent on veterans' benefits and services. For every dollar the government collected in taxes and fees, 19 cents went straight to paying interest on our existing debt. Think about that. Nearly 1 in every 5 tax dollars you pay doesn't go to roads, schools, or defense. It goes to pay interest on money we borrowed years ago. And a quarter of those interest payments flow to foreign countries, but including China, essentially funding their economic growth instead of our own. This Ferguson's Law phenomenon, first articulated in Niall Ferguson's 2025 Hoover Institution research, shows that by 2050, the Congressional Budget Office's Long-Term Budget Outlook 2025 projects that interest payments will be twice as large as defense spending. We're not just approaching this threshold, we've already crossed it. The human cost of this crisis is staggering. Today's debt burden equals $112,966 for every person in America, or $285,127 per household. But for children under 18, the generation that will inherit this mess, the burden is even more crushing. $500,000 per child. That's according to House Budget Committee Chairman Jody Arrington, one who called the national debt the United States' next great war. What makes this moment particularly dangerous is that all 3 major credit rating agencies have now downgraded U.S. debt for the first time in history. Standard & Poor's started the downgrades in 2011, Fitch followed in 2023, and Moody's completed the triple downgrade in May 2025, dropping the U.S. from its pristine AAA rating to AA1. Moody's was particularly blunt in their assessment. Successive U.S. administrations and Congress have failed to agree on measures to reverse the trend of large annual fiscal deficits and growing interest costs. They made it clear that they don't believe material multi-year reductions in mandatory spending and deficits will result from current fiscal proposals under consideration. The bond market, the foundation of global finance, is already showing signs of stress. The MOVE index, which tracks volatility in Treasury options, has reached levels not seen since the 2008 financial crisis on multiple occasions throughout 2024 and 2025. The 10-year Treasury yield has swung wildly between multi-decade highs above 5% and periodic declines below 4.5% within short time frames, creating an inverted yield curve that historically signals recession. Even more troubling, foreign investors are starting to retreat. China, once our largest foreign creditor, has steadily reduced its Treasury holdings from a peak of $1.3 trillion in 2013 to approximately $775 billion today. Some analysts believe China is already weaponizing its Treasury holdings as geopolitical tensions rise. But the debt crisis is just the beginning of our problems. We're racing toward what experts call the trust fund cliff of late 2032. That's when the trust funds supporting Social Security and Medicare, financial lifelines for nearly 70 million Americans, face complete insolvency, accelerated by the recently passed One Big Beautiful Bill Act. Unless Congress takes immediate action, Social Security benefits will be automatically cut by 24%, and Medicare benefits by 11% when these trust funds are depleted. For a typical couple turning 60 this year, this could mean losing approximately $18,400 in Social Security benefits annually. Maya McGuinness, president of the Committee for a Responsible Federal Budget, captured the dysfunction perfectly. The reality is that we're becoming distressingly numb to our own dysfunction. We fail to pass budgets, we blow past deadlines, we ignore fiscal safeguards, and we haggle over fractions of a budget while leaving the largest drivers untouched. The global context makes everything worse. Total global debt has surged to a record $323 trillion, with public debt alone reaching $102 trillion, an increase of $5 trillion just in 2024. The International Monetary Fund warns that global public debt will exceed 95% of gross domestic product, and then they're particularly concerned about financial turmoil driven by fiscal financial feedback loops. Here's what that means in plain English. When one major economy faces a debt crisis, it can trigger a cascade of failures across the global financial system. With the federal funds rate higher than it's been in decades and financial asset valuations stretched to historic extremes, the margin for error has essentially disappeared. The Congressional Budget Office's long-term budget outlook, 2025, paints an even grimmer picture. They project the debt-to-GDP ratio will hit 156% by 2055, with annual deficits reaching 9% of GDP by 2035. That means we'll be spending $14 trillion on interest payments alone over the next decade, more than 3 times the $4 trillion we spent on interest over the last decade. Some economists argue that a full-blown debt crisis is unlikely in the near term. They point to the dollar's role as the global reserve currency and the Federal Reserve's credibility as stabilizing factors. Moody's, despite their downgrade, acknowledged that the U.S. retains exceptional credit strengths, such as the size, resilience, and dynamism of its economy. But this perspective ignores the fundamental mathematics of compound interest and exponential growth. Even if we avoid an immediate crisis, the trajectory is unsustainable. Every day we delay addressing this problem, the eventual reckoning becomes more severe. The OECD projects that sovereign bond issuance will reach a record $17 trillion in 2025, up from $14 trillion in 2023. Nearly 45% of OECD countries' sovereign debt will mature by 2027, meaning governments worldwide will need to refinance massive amounts of debt at today's higher federal funds rate environment. It's a global refinancing cliff that coincides with our own fiscal crisis. What would a debt crisis actually look like? History provides some clues. When bond markets lose confidence, the 10-year Treasury yield can spike rapidly, making it exponentially more expensive to service existing debt. The UK experienced a preview of this in early 2025, as did Japan with its long-end bonds. Bond market analyst Ed Yardeni noted that bond vigilantes were screaming that they weren't happy with what was going on, and there was a potential for a recession. The feedback loop is vicious. Higher interest rates make debt service more expensive, which requires more borrowing, which pushes rates higher still. In extreme cases, governments face a choice between defaulting on their debt or inflating it away through money printing, both of which devastate ordinary citizens' savings and purchasing power. We're already seeing early warning signs in municipal and state finances. Several states are struggling with unfunded pension obligations and infrastructure needs, while federal support becomes increasingly uncertain. When the federal government can no longer backstop state and local finances, the crisis will hit Main Street directly through cuts to essential services. The political system seems incapable of addressing the crisis. Despite repeated warnings from nonpartisan watchdog groups, both parties continue to propose policies that would add trillions more to the debt. The recently passed One Big Beautiful Bill Act alone is projected to add $4.1 trillion to the debt through 2034. As we stand at this precipice, the question isn't whether we'll face a reckoning. It's when and how severe it will be. The $38 trillion debt milestone isn't just a number. It's a marker of how far we've traveled down a path that leads to fiscal collapse according to Ferguson's law. The solutions exist, but they require political courage that seems to be in short supply. Meaningful entitlement reform, tax system overhaul, and spending prioritization could still change our trajectory. But the window for gradual adjustment is rapidly closing. Every second we delay, another $69,713 is added to the tab that our children and grandchildren will inherit. The time bomb isn't ticking towards some distant future crisis. It's counting down to a reckoning that could arrive within this decade. The question facing America isn't whether we can continue this path indefinitely. The question is whether we have the wisdom to change course before mathematics forces that change upon us in the most painful way possible. The clock is ticking, and $38 trillion is just the beginning.